For 3.5 decades, the playbook for building wealth was beautifully simple. Find the S&P 500, buy a low-cost index fund, and then the most important part, hold it. Don't panic during downturns. Don't try to outsmart the market. Just hold on. This strategy worked because it was designed to work. You weren't picking individual winners. You were owning a tiny slice of the 500 biggest companies in America. Sure, some would stumble, but many more would rise, and over time, the entire market would grow. It was quiet, powerful, and incredibly effective. And then AI arrived. Suddenly, this reliable, decades-old strategy started to feel different. It brought up new questions, starting with the one big question that nobody really wanted to ask. What happens next? We're going to explore that. Make sure to subscribe so you don't miss it. Here's what most people believe when they invest in the S&P 500. They believe they own a piece of 500 different companies, spread across industries, sectors, sizes, protected by sheer variety. But here's the reality. For every single dollar that goes into the S&P 500 today, to 40 cents flows directly to just 10 companies. 10 out of 500. And of those 10, one company alone is capturing 7 to 8 cents of every dollar invested. Not because it was chosen, because the index is market cap weighted, meaning the bigger a company gets, the more of your money it automatically receives. It's a self-reinforcing machine. And right now, that machine is powered almost entirely by one thing. Strip out Berkshire Hathaway and JP Morgan, the two financial outliers in the top 10, and what remains is a group of companies all making the exact same bet. That artificial intelligence will define the next century of commerce. And they're financing that bet with staggering amounts of debt. To justify their current valuations, these AI-heavy companies would need to generate roughly $2 trillion in revenue. That's more than Nvidia, Microsoft, Apple, Alphabet, Amazon, and Meta combined earned in 2024. They're not being valued on what they own today. They're being valued on a future that hasn't been written yet. But there's a hidden cost. Equal weight funds constantly sell their best performers to top up the weakest ones. They trim the winners to feed the losers, just to stay balanced. More trading, higher costs, and historically lower long-term returns. So the answer isn't to abandon the S&P 500 entirely. The answer is to reduce its grip on the portfolio and redirect that freed capital somewhere smarter. In 1900, if you were a serious investor, the answer was obvious. Invest in Britain. The British Empire controlled vast stretches of the globe. London was the financial capital of the world. British companies dominated international trade. Investing anywhere else would have seemed almost reckless. And yet, history had other plans. Fast forward to the late 1980s. Japan was the story. Electronics, automobiles, technology. Japanese companies were consuming global markets share while the American economy struggled with inflation and stagnant growth. The narrative was clear. Japan was the future. The narrative was wrong. America came back, decisively. Japan entered a decade-long stagnation that the country is still, in many ways, recovering from. The single most consistent truth in 125 years of market history is that dominance rotates. No country holds the crown forever. No market is too big to be overtaken. There's a pattern that repeats itself throughout financial history. By the time everyone is talking about an investment, by the time it fills the headlines and the dinner party conversations, the best returns have already been made. Real wealth isn't built in the crowded room. It's built by finding the right door before everyone else does. The crowded zone is where passive money flows automatically. The defensive zone is where value investors build fortresses. The speculative zone is where hype replaces logic, and where fortunes are lost as quickly as they're imagined. But the overlooked zone, small companies, mid-cap businesses, under-the-radar innovators, this is where the next chapter of wealth is being quietly written. Here's the insight that changes everything about AI investing. More and more software companies are giving users a choice. Pick your AI model: Claude, ChatGPT, Gemini, whichever you prefer, because the models are converging. The gap in capability is closing. And when technology becomes interchangeable, when any of them can do roughly the same job, one factor rises above all others: price. Imagine two petrol stations. 1ch. Every great technological disruption in history has done two things simultaneously. It has created wealth, and it has destabilized the systems that came before. The printing press disrupted the church's information monopoly. The Industrial Revolution broke centuries of agrarian economics. The internet dissolved entire industries overnight. AI is no different. And when systems are disrupted, when trust in institutions wavers and the future feels genuinely uncertain, human beings have always reached for the same thing, gold. Not because it's exciting, because it endures. Since 2023, China has been buying gold at a pace that even seasoned economists find striking. Not quietly accumulating, actively deploying it. They've been constructing something called the Gold Corridor, a framework that allows gold to be stored across multiple locations and used as the bedrock of international trade, particularly among the BRICS nations: Brazil, Russia, India, China, and South Africa. And China isn't alone. For the first time since 1996, gold has overtaken U.S. Treasury bonds as the world's most held foreign reserve asset among central banks. That is not a small shift. That is a tectonic one. In 2025, gold was reclassified under Basel III as a Tier 1 asset, meaning financial institutions can now treat it exactly as they treat cash on their balance sheets. Before this change, there is a mistake that gets made over and over again. Not by the reckless, not by the uninformed, by the disciplined, the committed, the long-term thinkers. They build carefully for years. They stay the course through small dips. They understand the philosophy of holding through volatility. And then, life happens. A medical emergency, a redundancy, an unexpected cost with a deadline attached. And without sufficient cash reserves, there is only one option. Sell. Not at the top. Not at a neutral moment. At the bottom. When every share is worth less than it's ever been. Losses locked in permanently. Warren Buffett, the most studied investor alive, is currently sitting on $347.7 billion in cash. Not out of fear. Not because he's lost confidence in markets. Because he's patient. Because he knows that when genuine value appears, when markets overcorrect and prices detach from reality, having cash means having the ability to act. When the crash comes, and it always comes, cash is not a dead asset, it is a weapon. The dot-com crash created generational buying opportunities for those who were prepared. The 2008 financial crisis handed extraordinary returns to those who had the liquidity to buy, while others bled. Every CRA. Nobody knows what comes next, not the analysts, not the algorithms. Not the institutions buying gold and building cash piles. Every forecast is a probability. Every strategy is a bet. The question was never whether to trust the market. The question was whether to trust only one version of it. The S&P 500 remains the engine. If AI delivers on its promise, if the companies spending billions are right, that engine captures the growth. But the rest of the portfolio exists for a different reason. Not pessimism. Preparation. Because the most dangerous investor isn't the one who takes risks. It's the one who believes they've eliminated them. Don't predict the future. Prepare for all of it. In the grand ledger of life, some assets are measured in dollars, others in deeds. But the most valuable asset, the one that can never be devalued or taken away, is knowledge. It's the currency of progress, the inheritance of wisdom passed from one generation to the next. If you believe in the power of understanding, help us continue this journey. Join our community and let's build this wealth together.